Our next speaker has probably one of the 10 best-known names in the world of Wall Street and financial analysis, both by institutional money managers and economists and journalists, and also by individual investors. He is one of these rare individuals whose influence crosses the full financial spectrum. Robert Prechter is this speaker's name, and he has a reputation going back literally for decades for his extraordinarily perceptive analysis. He is a chartered market technician and president of Elliott Wave International. Bob's most recent financial title is Conquer the Crash, You Can Survive and Prosper in a Deflationary Crash and Depression. His book on social theory, which is a magnum opus in its own right, is Socioeconomics, the Science of History and Social Prediction. Bob resides at www.elliottwave, that's ELLIOTTWAVE.com. www.elliottwave.com. Bob spoke here last year, and the day before he made his appearance, a lady came up to me, very seriously, and asked me if Mr. Prechter was going to be able to speak. And I said yes, that Bob definitely would be speaking tomorrow, and that it probably would be one of the most controversial speeches of the whole seminar. And she replied, "Oh, goody, I just love him, the way he makes me so afraid." So at this time, the man who makes people so very afraid. Robert?
I don't know about that. I thought that my title today was a little radical, and then I said, what am I talking about? It's the New Orleans Conference. I'll probably be considered a moderate. Anyway, I hope we can put the first slide up here, and there we go. We have a lot to cover in a short period of time, so I'm going to be running through what I think are the most important charts that I can show you to sum up the way I see things. It's a bit of a contrary opinion. This is a picture of what my two colleagues, Steve Hochberg and Pete Kendall, showed in the summer of 2005 regarding real estate. This is a chart of the Home Builder Stock Index. And they were saying at the time, housing is reaching its home stretch, and in September, as you can see in the upper right-hand corner, a bear market in real estate has just begun. That was after more than a 900% move up in the home building stock index. Now what happened afterwards? So far, this home building index has retraced most of the entire advance from 2000. This is the way bubbles reverse. It's very important to take a look at this picture because we're going to see some things that are closer to the top, and we're going to be making comments just as they made back in 2005 that we are close to a reversal. This is the housing market. Now this I do not believe is over yet, but let's see some of the devastation that's occurred in various areas in the housing market. These are existing and pending home sales over here. Of course, they have been plummeting ever since 2005. New homes for sale in the United States have been going up, and this is a quarter out of date. That line's even higher now. The number of for sale signs, in other words, outside homes in the United States. This is the percentage of homes in the United States that nobody lives in. They're unoccupied, and there are a few things that lose value faster than a home with nobody in it. Housing starts, fascinating chart. This is the one that most people watch, in the weekly and monthly figures. If you're following the stock market. If you look at the upper right hand of this chart, you'll see housing starts continued upward even as prices were beginning to sink. That's because in the initial drop in a downturn, people believe it's only temporary. So more and more builders were starting new homes even though the downturn had already occurred. Of course, once they realized that someone had flipped a switch, housing starts have plummeted to half what they were at the peak in late 2005. Now, someone might say with all of these lines, perhaps real estate is near or at a bottom. This chart shows why that is nearly impossibly the case. This is a chart we call housing affordability. It's the price of a home, the average price of a home in the United States as compared to the average income for the average American. How affordable is that home? And you'll see 2 points, or 3 points actually, in the past when stocks were very affordable relative to income. That's the lower part of the line. And several times when they were expensive. Well, they have been expensive and they are still expensive at the moment relative to income. In fact, greater than at any time in this 30-year history we have up here. So there is a long way to go before houses are reasonable relative to income. And if we go into a recession or a depression and income falls, it's going to be even more difficult for that line to go down. All right, now let's look at the stock market. We've taken a look at real estate. It looks like it's topped out 2 years ago. It's got more to go. This is a picture you won't see in the Wall Street Journal or on CNBC. This is a picture of the Dow Jones Industrial Average, not the one they show you denominated in dollars. It's making a new all-time high. This is the one denominated in real money, which I don't have to explain to this audience. This is the Dow in terms of gold. How many ounces of gold does it take to buy the Dow Industrial Average? The amazing thing about the chart isn't so much how much it's come down recently, but how persistently it went up. From January 1980 all the way until 1999, people preferred at a manic rate stocks over gold. They wanted stocks instead of real money. That was the true stock market mania right there. Ever since 1999, stocks have been losing their ability to buy real money. In other words, 2/3 of a drop in the Dow. This is a real crash going on, but it's a hidden crash. People don't see it because it's reflected in the inflation that's occurred in the credit markets, and therefore the nominal prices are staying up, but the real values are going down. Now someone might say, well, okay, gold's had a pretty good run. Maybe that's only one thing against which stocks are falling, but no. This is a picture of how much in terms of commodities that the Dow can buy, and it's been even larger than that. In other words, gold, is, if anything, has lagged the average commodity. So a 71% decline in the purchasing power of the Dow Jones Industrial Average since 1999. That's a huge drop. I think we have been in a crash all that time, and it's still going on. Now again, someone might look at this chart and say, all right, we've had a pretty big drop in the real value of stocks. Maybe they're actually at a bottom. But again, I think we can show many, many indicators as to why that is absolutely not the case. I like this one a lot. On the x-axis of this particular graph, we have a plot of how long it's been that there have been more bulls among newsletter advisors on the stock market than bears. Now, as you all know, I'm sure, optimism is what creates tops. When people are bullish and they think things are going higher forever and they're all in agreement, or most of them are in agreement, that's classic conditions of a top. Pessimism comes in at a bottom. On the y-axis, what we have is a measure of dividend payout. How long have stocks, the Dow Jones Industrial Average, been yielding a historically low dividend? Now, what does a low dividend mean? It means the buyers are so optimistic and bullish about the stock market that they think they're going to get rich in capital gains. So we don't need any dividends. The amazing thing about this is we're not comparing to past bottoms, but to the greatest tops of the last 80 years. If you look in the bottom left corner here, I've listed the great historic tops of 1929, 1937, 1968, 1973, and 1987 in August before the crash. What you see is that generally speaking, bulls would outnumber bears in the advisory services between a half a year and 3 years at the most. And that was enough optimism to kill the market and create one of the biggest tops of the last 80 years. Looking up the vertical scale, the dividends would be extremely low, historically low, for less than a year. Usually about 7 or 8 months was enough. In 1987, it was only 3 months, and then the market crashed. Now look at where the January 2000 peak was. It was about average in terms of how long the advisors were bullish, but in terms of how long the dividend yield was very, very low, almost non-existent. Well, look at that. It was 7.5 years. That was a real outlier at the time. At the time, I thought, we'll never see anything like that again. And here we are in October 2007, and look at that bullet point way up in the upper right-hand corner. That's where we are today. It's been 9 years of complete bulls more than bears every single week, 51 out of 52 weeks during the year for the last 9 years. Before, it would only take a few months, and that would be enough. And if you look at the vertical axis, dividend payout for the Dow has been historically low for 14 years. We've never seen anything like it. It's been the longest hold-your-breath bubble that's ever been. And with that much optimism and that length of time of optimism, there's no way that the stock market decline is over yet either.